three key themes emerge from the clauses on inventories. The primary requirement for the auditors to comment with respect to inventories is threefold. First, whether the management has conducted physical verification of inventories at reasonable intervals, whether the coverage and the procedure for such verification by management is appropriate. Finally, if there are discrepancies which are greater than 10% at each class of inventory, whether they have been appropriately dealt with in the books of accounts. What an auditor would expect here is that at the end of the day, verification of inventory is the responsibility of the management. It is not the auditor's responsibility to verify inventory. It's that of the management. The management's responsibility is typically discharged by issuing instructions to staff, instructing external vendors, instructing counterparties to send confirmations. So the auditor will in reality check whether these basic steps have happened or not. Some of these items can also be checked when the auditor participates in the physical verification process. What are the steps that management has taken to verify inventory? The other important piece is that the physical verification and the books or the inventory as per books, if they are different by more than 10%, then they trigger an assessment or a reporting requirement. In the older versions of CARO, this was one of the clauses that the auditor had to report. But at that time, the auditor always went by the principles of materiality. So to give you an example, let me suppose I have packing material and the books suggest that the packing material quantity or value should be 100, but the value of packing material that is actually found in physical count is 90. Now, if packing material is, let us say, 0.5% of total inventory, the auditor would never report it because they would look at materiality on an overall basis. In CARO 2020, the materiality is at a class of asset level. And when one talks of class of assets in respect of inventories, some of these commonly known classes under Ind AS 2 or AS 2 are class of assets such as merchandise, finished goods, work in progress, and so on. If you have goods in transit should form a part of the respective class to which that inventory belongs. There are a few questions that I am seeing on the chat box. We will reply to each of them. If we can't reply right away, we will take those questions back and come back to you when we meet next. So this is the entire piece around verification of inventory and management's discharge of the responsibilities around the procedures for physical verification of inventory. One very new and interesting reporting requirement that has come up is managements will now have to reconcile the quarterly information that they submit to lenders with what is there in the books of accounts. Another very, very relevant requirement in the current environment, it is very common observation of those who have been involved in bank audits or banking industry, is that there are many borrowers who look to inflate debtors in stock and thereby look to have a greater limit for their working capital borrowing. And that's a correction that the auditors will now have to test. So a very important data point, if you are a credit officer reviewing financial statements of borrowers, what this clause requires is, the gating question is, if at any time during the year, the company has been sanctioned a limit of more than 5 crores in aggregate by banks and financial institutions, then the reporting requirement under this clause triggers. And sanction includes renewal of limits as well. Fund-based limits, non-fund-based limits, both of them are considered in the threshold for 5 crores. So if if there is a working capital facility against or on the basis of current assets that has been obtained by the company, then this reporting is triggered. So if somebody placed a charge on fixed assets and got a facility of 10 crores and did not have any other loan facility, reporting under this clause would not trigger. Now let's assume that this entity has indeed taken or has indeed got a sanction of more than 5 crores against stock and receivables. What CARO 2020 requires the auditor to now do is say, you would have at a periodic interval reported your data to the bank. As the auditor, we want you to go back and reconcile whether the information submitted to the lenders was in agreement with the books of accounts. So if as a company, your company submits stock statements, statements of receivables, aging of receivables, it is actually expected that for all the quarter end months, the auditor will come and ask you to show how the numbers compare to the trial balance. The auditor is not expected to audit quarterly numbers. They will just simply come and state, please show me your trial balance. I would like to see the number of inventory that you have over there, and I would like to see the statement you sent to the bank. If there is a difference, then a reconciliation needs to be prepared. And if the auditor is not satisfied with the explanations, this is an item that will get reported. That management had inventory of X, but the amount reported to the banks was X plus 20. And now it is for the reader, therefore, to understand, and for the lender, therefore, to understand in more detail why happened or what happened that this difference was created. So very, very relevant data point if you are a lender, if you are evaluating a company. The key takeaways that we have from this is a lot of commentary from auditors will now come on unaudited books of accounts. The auditor will look at your trial balance, which is unaudited, and look at stock statements. If there is a practice of sending monthly returns, the auditor will disregard monthly returns and only look at the months at the end of the quarter. So it's June, September, December, March that the auditor is interested in. So a very important and a new kind of a requirement that has been triggered by CARO 2020. Auditors will comment on reasonableness of how management believes the verification should happen. 10% threshold for discrepancies is on a net basis and for each class of inventory. And as I mentioned, the definition of materiality is very different. The materiality threshold is 10% and at a class level. So this is what we had to cover in terms of inventories and non-financial assets. Once again, this is an area where one should start work at the earliest, look at what stock statements have gone, look at what is there in the trial balance. This is probably also something that could call into question how updated the company's IFC procedures and policies are. So for example, one would then start to expect that the data that goes to a bank undergoes a certain internal financial control process to validate that the data that is going is accurate and reliable. With that,